Are you looking for the next big ETFs to buy before 2025, but not sure where to start? With market uncertainty and Federal Reserve rate cuts changing the landscape, now is the perfect time to diversify your portfolio. But which ETFs should you focus on? In today's video, we're going to reveal 4 secret ETFs that could offer the perfect blend of growth, value, and stability for the months ahead. These ETFs are not just about high returns. They're about crafting a smart, balanced portfolio that can weather any market storm. But before we dive into these hidden gems, do me a huge favor. Hit that like button, subscribe to the channel, and let's build our financial future together. What if you could balance your high-risk growth stocks with something more stable and still enjoy strong returns? That's exactly what the Vanguard Value ETF, VTV, offers. An ETF built around some of the most solid, reliable companies in the market, with net assets of $183.19 billion and a market price of $176. VTV is designed for investors who want to focus on value without sacrificing performance. Why should you care? Let's break it down. VTV has a stellar year-to-date return of 17% and has surged 28% over the past year, making it one of the strongest value ETFs out there. Over the last 5 years, VTV has returned a whopping 60%, proving that value investing doesn't mean slow growth. It means smart, steady returns over time. And what about costs? This ETF boasts one of the lowest expense ratios in the industry at just 0.04%, making it incredibly cost-effective for investors. Combine that with a dividend yield of 2.09%, and you're looking at a solid annual dividend of $3.65 per share, providing consistent income while your portfolio grows. Now, let's look at VTV's diversification. It holds 345 companies across multiple sectors, with financial services, 21.83%, and healthcare, 18.08%, leading the pack. But it doesn't stop there. You also get exposure to industrials, technology, and consumer defensive stocks, giving you a balanced mix that can weather market shifts. This diversified sector exposure is key to managing risk while capturing long-term growth. As for the top holdings, you're getting some of the biggest names in business: Broadcom Inc., Berkshire Hathaway, JP Morgan Chase, and ExxonMobil, to name a few. These companies are leaders in their fields, offering stability and consistent returns. Why does this matter? Going into 2025, the market is uncertain, but with VTV, you're aligning yourself with companies that have historically thrived in all economic conditions. Whether it's financial services giants like JP Morgan or healthcare powerhouses like United Health Group, VTV gives you access to firms that consistently outperform. So if you're looking for a way to balance out your high-growth stocks, Vanguard Value ETF is your ticket to stability, income, and long-term gains. With a broad sector mix and exposure to industry leaders, VTV is a must-consider for any investor aiming for both growth and value. Looking to add some real estate exposure to your portfolio without the hassle of buying physical property? The Schwab U.S. REIT ETF, SCHH, offers a simple, cost-effective way to tap into the real estate sector, which is known for its ability to generate steady income and long-term growth. With total net assets of $8.03 billion and a market price of just $22, SCHH makes real estate investing more accessible than ever. What sets SCHH apart? For starters, it focuses 100% on real estate holdings, providing pure exposure to this sector. And here's the kicker. It comes with a low expense ratio of just 0.07%, meaning more of your money stays invested rather than eaten up by fees. Now, let's talk about returns. SCHH has delivered a year-to-date return of 7% and surged 27% over the past year, making it a standout performer in the real estate space. Even as interest rates fluctuate, REITs like those in SCHH tend to benefit from lower rates, which could continue to drive growth heading into 2025. But that's not all. SCHH offers an attractive dividend yield of 2.49%, with an annual dividend of $0.56 per share. That's solid income from your investment, making SCHH an appealing choice for both growth and income-focused investors. What about the holdings? SCHH features 124 high-quality real estate stocks, giving you diversified exposure across the sector. Its top holdings include some of the biggest names in real estate, like Prologis, Inc., which makes up 8.10% of the fund, and American Tower Corporation at 7.49%. These companies are leaders in commercial real estate, data centers, and infrastructure, ensuring you're not just investing in traditional real estate but also in the future of the sector. You'll also find top names like Equinix, Welltower, and Public Storage, all of which have a history of stable cash flow and strong performance. By investing in SCHH, you're effectively owning a piece of some of the most profitable and resilient real estate assets without the hassle of property management. Why is this important now? With the real estate market poised for a rebound as interest rates ease, REITs could see significant upside. SCHH positions you to capitalize on this trend while benefiting from steady income streams through dividends. So, if you're looking for an easy way to gain diversified exposure to the real estate sector, Schwab U.S. REIT ETF is a smart choice for your portfolio, delivering growth, income, and diversification in one package. Want to tap into the growth potential of smaller companies without taking on the massive risk of individual stock picks? Enter the iShares Core S&P Small-Cap ETF, IJR. A smart, low-cost way to capture the upside of small-cap stocks while minimizing risk through diversification. With net assets of $86.13 billion and a market price of $116, IJR is one of the largest and most popular small-cap ETFs in the market today. Why should small-cap stocks be on your radar? Small caps are often more sensitive to interest rate changes, and with rates expected to decline, small companies could be primed for a strong performance heading into 2025. Already, IJR has delivered a year-to-date return of 8%, and over the past year, it's up an impressive 27%. Even more impressive, its 5-year return sits at 51%, proving that small caps aren't just risky, they can be incredibly rewarding if you have the right exposure. One of the biggest advantages of IJR is its expense ratio of just 0.06%, making it a cost-efficient option for long-term investors. On top of that, IJR offers a quarterly dividend, with a dividend yield of 1.32% and $1.51 paid per share over the past year. That's steady income, while you hold your position and wait for these small companies to grow. Now, let's talk about what you're actually investing in. IJR holds a total of 632 companies, giving you broad exposure to the small-cap universe. The ETF is heavily weighted towards industrials, 17.52%, financial services, 17.15%, and consumer cyclical stocks, 14.70%, sectors that are likely to benefit from an improving economic outlook and lower interest rates. But it's also well diversified across sectors like technology, healthcare, and real estate, giving you a balanced portfolio that can thrive in various market conditions. Top holdings. While IJR holds a wide variety of companies, some of the top names include XTSLA 1.57%, Mueller Industries 0.62%, and ATI Inc. 0.61%. These are companies that may not be household names yet, but they have the potential for substantial growth as small businesses tend to outperform in periods of economic expansion. Why is this important now? Small-cap stocks have historically outperformed large caps during economic recoveries, and with the market positioning for a potential rebound, IJR could be a great way to capitalize on that growth. Plus, by investing in IJR, you're getting diversified exposure to the small-cap space, which lowers your risk compared to picking individual stocks. So, if you're looking to add a high-growth element to your portfolio with manageable risk, the iShares Core S&P Small-Cap ETF is a must-consider. It's diversified, low-cost, and packed with potential for both growth and income. What if you could invest in the future of technology and innovation without betting on just one company? The Schwab U.S. Large Cap Growth ETF, SCHG, gives you a low-cost way to own a slice of the world's most innovative, fast-growing companies. And a market price of $26, SCHG provides exposure to industry giants that are shaping tomorrow's economy. Why should SCHG be on your radar? It's delivered a year-to-date return of 29%, and an impressive 42% return over the past year. Over the long term, SCHG has really shined, boasting a 5-year return of 150%. These numbers are hard to ignore, especially if you're looking for a growth play in the current market. Even better, SCHG comes with an expense ratio of just 0.04%, one of the lowest in its class, making it incredibly efficient for long-term investors. Add in a dividend yield of 1.67% with an annual dividend of $0.44, and you've got a growth ETF that not only delivers capital appreciation, but also pays out regular income. What makes SCHG so compelling is its sector allocation. Technology dominates the portfolio at 50.26%, followed by communication services, 13.08%, and consumer cyclical, 11.71%. These sectors are packed with high growth potential, meaning SCHG positions you to benefit from the next wave of innovation. Now, let's talk about the top holdings. It reads like a who's who of market movers. Apple Inc., 12.44%. Microsoft Corporation, 11.43%. NVIDIA Corporation, 10.72%. Amazon.com, Inc., 6.30%. Meta Platforms, Inc., 4.45%. Alphabet Inc., 3.45%. Together, these top holdings represent the cutting edge of tech and innovation. By investing in SCHG, you get access to the biggest players in these sectors without putting all your eggs in one basket. Why is this important now? As we move toward 2025, the technology and growth sectors are set to benefit from both economic recovery and advancements in artificial intelligence, cloud computing, and e-commerce. SCHG lets you capture these trends in a single diversified investment. So, if you're looking for a way to invest in high-growth companies with an eye on the future, Schwab U.S. Large Cap Growth ETF is a powerful choice for your portfolio, combining stellar growth potential with the stability of large-cap names. So, what's the key takeaway here? As we look toward 2025, building a diversified portfolio that can handle market turbulence is more important than ever. The 4 ETFs we've discussed today offer a balanced approach, combining growth, value, income, and sector-specific plays. Whether you're betting on the technology giants with SCHG, tapping into the resilience of Vanguard Value ETF, VTV, gaining exposure to real estate's steady returns with Schwab U.S. REIT ETF, SCHH, or taking advantage of small-cap growth with iShares Core S&P Small-Cap ETF, IJR, you're positioning yourself for long-term success. Each of these ETFs brings something different to the table, from tech-driven growth to stable dividend payouts and sector-specific opportunities. The best part? They're all designed with low expense ratios, which means more of your money is working for you, not against you. Diversification is key, and these ETFs provide it across sectors, asset classes, and strategies. As we navigate a changing market environment, with potential rate cuts, economic shifts, and technological advancements, having a well-rounded portfolio is critical to both mitigating risk and capturing upside potential. So now it's your turn. Take a closer look at your portfolio. Are you exposed to the right mix of growth, value, and sector plays? If not, consider adding one or all of these 4 secret ETFs to your strategy before 2025. And, as always, if you enjoyed today's video, don't forget to like, subscribe, and share this with anyone who's looking to optimize their investing game. Stay tuned for more insights, and let's keep growing our wealth together.